There are a few basic notions regarding risk that you should comprehend whether you're day trading or swing trading. These serve as the cornerstone for your market knowledge and serve as a guide for your trading actions and investing selections. You won't be able to safeguard and increase your trading account otherwise. We've previously spoken about risk management, position size, and putting a stop loss in place. However, if you are actively trading, there is something you must realize. How much risk are you willing to take in comparison to the possible reward? How do your potential upside and possible downside compare? To put it another way, what is your risk-reward ratio? We'll go through how to calculate the risk-reward ratio for your trades in this post. How is the risk-reward ratio calculated? The risk-reward ratio, R ratio or R, determines how much risk a trader is willing to take for how much possible reward. In other words, it demonstrates the possible profits for every $1 invested. The calculation is straightforward. You take your maximum risk and divide it by your net goal profit. How do you go about doing that? First, consider where you want to join the trade. Then you pick where you would collect gains, if the trade is profitable, and where you would place your stop loss, if the trade is losing. This is critical if you want to effectively manage your risk. Before starting a trade, good traders determine their profit objectives and stop loss levels. Now that you've determined your entry and exit points, you can calculate your risk-reward ratio. This is accomplished by dividing your possible risk by your potential reward. The smaller the ratio, the greater the potential reward per unit of risk. Let's see how it plays out in practice. How to calculate the risk-reward ratio. Assume you wish to take a long position in Bitcoin. You do your research and estimate that your take-profit order will be 15% higher than your entry price. You also ask the following question at the same time. Where has your trade proposal been rendered ineffective? That is where your stop-loss order should be placed. In this situation, you choose a 5% deviation from your entry point as your invalidation point. It should be noted that they should not be based on random percentages. Based on your market research, you should set a profit objective and a stop-loss. Technical analysis indicators may be quite beneficial. As a result, our profit goal is 15% and our possible loss is 5%. What is our risk-reward ratio? The calculation is straightforward. Potential loss, potential profit equals risk-reward ratio. It is 5/15 equals 1 to 3 equals 0.33 in this example. That is all. This indicates that for every unit of risk, we may gain 3 times the reward. In other words, for every dollar we risk, we stand to win 3. So, if we have a $100 investment, we risk losing $5 for a possible $15 profit. To reduce the ratio, we might move our stop loss closer to our entrance. However, as previously stated, entrance and exit points should not be determined by arbitrary numbers. They should be computed based on our findings. If the risk-reward ratio of the trade setting is high, it's generally not worth it to attempt to game the figures. It may be preferable to move on and seek an alternative setting with a favorable risk-reward ratio. It should be noted that positions of varying sizes might have the same risk-reward ratio. For example, if we have a $10,000 bet, we risk losing $500 for a possible $1,500 profit. The ratio is still 1 to 3. Only the relative location of our goal and stop loss causes the ratio to change. The risk-reward ratio. It should be noted that many traders do this calculation backwards, calculating the reward-risk ratio instead. Why? It's just a question of personal choice. Some people find this simpler to grasp. The formula is the calculation of the risk-reward ratio formula. As a result, in the above example, our reward-risk ratio would be 15/5 equals 3. A high reward-risk ratio is preferable to a low reward-risk ratio, as one would assume. Risk and reward are defined. Assume we're in the zoo and place a wager. If you sneak inside the birdhouse and feed a parrot with your hands, I'll pay you 1 BTC. What is the possible risk? Well, since you're doing anything illegal, the cops may arrest you. However, if you are successful, you will get 1 BTC. Simultaneously, I present an alternative. If you sneak inside the tiger cage and serve raw meat to the tiger with your bare hands, I'll pay you 1.1 BTC. What is the possible risk here? Sure, the cops can haul you away. However, there is a danger that the tiger may attack you and kill you. On the other hand, the upside is somewhat higher than with the parrot bet since you gain a little more BTC if you win. Which seems to be the better deal? Both are technically poor bargains since you shouldn't be sneaking about like that. Nonetheless, the tiger bet entails somewhat greater risk for just a little higher possible reward. Similarly, many traders will seek trade situations in which they stand to win much more than they stand to lose. This is referred to as an asymmetric opportunity. The potential upside is greater than the potential downside. Combining the risk-reward ratio with additional ratios. The victory rate is one of the ratios used in conjunction with the risk-reward ratio. Your win rate is calculated by dividing the number of winning trades by the number of lost trades. For instance, if you have a 60% win rate, you are profiting on 60% of your trades, on average. Let's look at how you can apply this to risk management. For example, a trader who buys and sells options may risk losing $100 in order to make $700. Their risk-reward ratio is 1 to 7 in this scenario. However, the options they are trading for are dangerous and can only yield a 20% success rate. Keeping the win rate in mind, consider the following scenario. If they execute 10 $100 trades while investing $1,000, they have a chance to gain $1,400. Using these calculations, both the risk-reward ratio and the victory rate, the trader may assume that his actions have a larger possibility of profit than of loss. But what if the trader only received $500 for each successful option trade? They would then only get $1,000 in return for their $1,000 trades. This is only the break-even point. With a 20% win ratio, his risk-reward ratio should be at least 1 to 5. Traders may use their previous win rate to calculate a risk-reward ratio that will predict their prospective profit while trading. However, this use of the risk-reward ratio is quite restricted. It's almost hard to predict the victory ratio of a future trade or activity, and you can only work with data from the past. However, combining the risk-reward ratio with another indicator might be an additional tool in a trader's toolbox. Final thoughts. We've discussed the risk-reward ratio and how traders may include it into their trading strategy. When it comes to the risk profile of any money management approach, calculating the risk-reward ratio is critical. Keeping a trading log is another something to think about when it comes to risk. You may gain a more accurate view of the performance of your methods by recording your trades. Furthermore, you may be able to modify them to other market situations and asset classes. Nonetheless, some traders may be quite lucrative while having a very low winning rate. Why? Because the risk-reward ratio on their particular trade settings accounts for it. They could lose 9 trades in a row and still break even if they only took setups with a risk-reward ratio of 1:10. In this situation, they'd only need to win 2 out of 10 trades to be successful. This is when the risk versus reward calculation comes into play. Furthermore, the win-loss ratio may be utilized to calculate a trader's risk-reward ratio. When combined with your win rate, your win-loss ratio is your winning trades divided by your losing trades, which helps you determine your success rate. For example, if your win-loss ratio is 60%, you are losing 60% of the time. This may also be used in risk management since it allows you to calculate your risk-reward ratio. Traders may calculate their risk-reward ratio by using various ratio formulas such as win rate and win-loss ratio. More particularly, they may evaluate the risks that a trader may face by calculating the worth of their winnings and losses. Thank you for watching.